Algorithmic trading can be tough, especially when you're just starting out, since there are seemingly so many things to look out for. In this video, we're going to cover some of the biggest and most common algorithmic trading mistakes. Avoiding all of these mistakes can lead to a significant improvement in your trading performance. With that being said, let's jump right into it. When developing a trading algorithm, you use historical data to test your algorithm and analyze its past performance. This gives you great feedback as to how good or bad your algorithm would have performed over the chosen time frame. Even though backtesting is a great tool that is fundamental for any algorithmic trader, it can also be dangerous. If done incorrectly, backtesting can do more harm than good. The first algorithmic trading mistake that we're going to look at is a classic backtesting mistake. One of the biggest and most common backtesting mistakes is overfitting. Overfitting is the act of over-optimizing your algorithm to the test data. Let me give you a specific example to clarify this. This is the price chart of XYZ over a selected week. From this pricing data, you could create a trading algorithm that buys XYZ on Monday, sells XYZ on Tuesday, buys on Wednesday, and finally sells on Thursday. Over this week, this algorithm is probably one of the best performing algorithms that exists. But if you look at any other week, this algorithm will probably perform terrible, since the entire idea behind this algorithm is based on this 1 week of pricing data. In other words, this algorithm is overfitted to this week. Even though backtesting this algorithm over this week shows great returns, this algorithm is utterly useless. So when backtesting, it is fundamental not to over-optimize your algorithm to historical data. One of the best ways to avoid overfitting is leaving a good percentage of the available test data untouched. For example, you can only use about 60% of the available historical data when developing your algo. As soon as you think your algo is at a far enough stage, you can test it on the untouched data. If the algo's performance is significantly worse on the untouched data than on the data you used to develop it, you probably overfitted it. Another common algorithmic trading mistake is using data in your algorithms that isn't actually available at the time. The easiest example of this is the daily high or low. An algorithm that buys at the daily low and sells at the daily high will have a phenomenal historical performance, but in reality it won't really work because you don't know the daily high or low beforehand. Using daily highs and lows in your algorithm might seem like an obvious mistake, but there are similar situations that aren't as obvious. So always make sure that your algorithm only uses information that actually is known before they use it. The worst part about this mistake is that it can be very hard to notice it, since backtesting won't help you realize that you are making this mistake. An algorithm that uses future data to make decisions will work great in backtesting, but terrible with live data since it can't actually access future data. One way to avoid this mistake is walk-forward testing. Walk-forward testing is basically the opposite of backtesting. Instead of using past data to test your algorithm, you use live data to test it, but without actually risking any money. So walk-forward testing is basically the paper trading of algorithmic trading. This brings us to our next algo trading mistake, namely not walk-forward testing your algorithms. Compared to backtesting, walk-forward testing can be quite tedious and boring. Backtesting allows you to test your algorithm on years of data in a matter of minutes, whereas walk-forward testing takes 1 day for 1 day of trading data. Due to this, walk-forward testing is often overlooked or ignored altogether. This is a huge mistake, since walk-forward testing is one of the best ways to test your algorithm without running the risk of falling prey to backtesting mistakes. Great walk-forward test results are far more important than great backtest results. Backtesting results can be good for a variety of reasons other than that your algo actually is good. Overfitting or using future data to predict the future are just two examples that can lead to great backtest results. Walk-forward testing is immune to such errors, which makes it a great tool to test your strategies. With that being said, it is important to be patient and not to jump to any conclusions. 1 day or week of walk-forward test results aren't enough to say whether your algo is good or bad. The next major algo trading mistake that is made way too often is not accounting for trade costs. When testing an algorithm, most people account for the obvious trade costs such as trading commissions and fees. But besides these costs, there are various other trading costs that can have a significantly bigger impact to your bottom line. Let me give you a few examples. First off, it is important to account for costs associated with liquidity. Depending on what you trade, a good assumption is to say that you always have to pay the bid-ask spread when you're opening or closing trades. Furthermore, depending on your trade volume, you should also account for slippage. If a security is thinly traded and you're using limit orders, which you should, you sometimes won't be able to get in or out of the position at all. Many backtesting engines don't account for this, which can lead to unrealistic results. Last but not least, depending on what you're trading, there might be additional costs associated to your trading. For instance, if you short sell a given security, it is important to consider the costs of shorting. Besides accounting for borrow fees, you should also account for the fact that there sometimes might not even be any shares to short. Remember that not every security can always be shorted. Hopefully, these examples give you an idea about what trading costs and restrictions you should think about when developing and testing your trading algorithms. Certain backtest engines already account for some of these trade costs, so if you are using a commercial backtester, it can be a good idea to check how trade costs are being handled. A different algorithmic trading mistake is going too big too soon. After your algorithm has performed great during some backtests, you might be excited and eager to test it out with real money. But often your algorithm isn't actually ready for that yet. Instead, you should continue refining it, adding some safeguards, stress testing it, walk forward testing it, and so on. Only after you have done all these things and your algo has passed all the necessary tests, you should start allocating real money to it. But even then, you should not start with any significant amount of capital. Instead, start out small with very little risk. Depending on the implementation and broker integration, some problems might pop up, and believe me, you much rather want to find these problems with a few $1,000s at risk than with a few $1,000s on the line. Another big trading mistake is not trusting your algorithm. If you have done all the just mentioned steps, there's no reason for you not to trust your algo. That doesn't mean that you should blindly throw money at it and let it do its thing, but you shouldn't constantly interfere with what it's doing. If you step in and manually change a trade every second day, you won't be able to analyze the algorithm's true performance since it never gets the chance to actually trade. So make sure to give your algo some breathing room. With that being said, you should still keep a close eye on what it's doing. If it starts making trades that don't seem to make any sense at all, it can be a good idea to double check and potentially step in and override it. The next mistake that I want to talk about is copying someone else's code. Sometimes you might be very inclined to just use someone else's code. If you're just starting out, that's one of the best ways to get started and get to know the basics of algo trading. But besides using other people's code to learn or as a rough template for you to start with, you should stay away from copy-pasting code that isn't yours. The problem with copying someone else's code is that you might not fully understand what's actually going on, so unless you really understand what's happening and fully understand the idea behind the code, you shouldn't just use someone else's code. Instead, try to develop your own trading algorithms. This will also give you a much better learning experience. And just to make sure, I want to re-emphasize that this does not mean that you can't use parts of other people's code to help you understand the concepts or to learn how to do certain things. You just shouldn't copy-paste someone else's entire trading algorithm and expect it to work for you. The next algorithmic trading mistake is a general programming mistake that is especially common amongst beginning programmers, namely not commenting your code. When coding a trading algorithm, or anything else for that matter, you should always leave complementing comments that help you understand what your code is doing. When programming, this might seem somewhat unnecessary, since at that point you likely understand everything. But if you don't touch that piece of code for just 2 or 3 weeks, it will already be much harder to grasp what's actually going on. The more advanced your code is, the bigger this problem becomes. That's why it is fundamental to leave comments inside your code that will help future you understand what's going on. When writing the code, try to leave comments so that even someone who has never seen your code before would understand it. The 9th algorithmic trading mistake is only paying attention to the total return of your algorithms. When developing, analyzing, and comparing your trading algos, you need some method to evaluate their performances. The most obvious and easiest way to assess an algorithm's performance is its total return. At the end of the day, you want to make the most money possible, right? Well, I'd argue that the way you make the money is just as important. Let me give you a very simple example. For this example, we will compare the performance of two trading algorithms. This is the percentage return chart of the first algorithm over 1 year. As you can see, it had a total yearly return of 40%. And here's the chart of the second algo, which only had a yearly return of 30%. Which of these algorithms would you rather allocate your money to? Even though the first one outperformed the second one in regards to the total return, it also was down 80% at a certain point. Most traders won't continue using an algo after it loses 80% over a few months. This means they would never even have experienced the recovery. Hopefully, this example shows that the total return of a trading strategy isn't the best measure to evaluate and compare different algorithms. Therefore, it's important to look at other metrics besides return. Some helpful measures are the risk, volatility of returns, max drawdown periods, and more. Certain indicators incorporate metrics such as volatility, risk, and performance into one measure. One of these indicators is the Sharpe ratio. This is a great indicator that allows you to easily and quickly gauge and compare the performance of your algorithms. The last mistake that I want to talk about is not having a strategy when creating your trading algorithm. There is a very important step that you need to do before creating a trading algorithm, and that's developing a trading strategy. A trading algorithm simply is a concrete implementation of an abstract trading strategy. The trading strategy can be thought of as the idea and the algorithm the execution. Developing a trading strategy is all about coming up with lots of ideas, testing their validity, and moving on. Let me give you an example. One possible idea might be that the two major market ETFs SPY and QQQ are heavily correlated, and there might be an edge in trading around the temporary price discrepancies. The next step would be to partially test this hypothesis by looking at SPY's and QQQ's historical correlation. If everything looks good, you could start trying to build some sort of strategy around this idea. If you want to see some more detailed examples of possible trading strategies, I highly recommend checking out my recent video on the different types of algorithmic trading strategies that exist. Let's now quickly sum up the algorithmic trading mistakes that we covered in this video. First, make sure not to overfit your algorithms to the backtest data. One way to avoid doing this is by leaving a certain percentage of the available backtest data untouched for later. Secondly, make sure that all the information that your algorithm uses is in fact known at the time that it uses it. Predicting the future with future information only works if the future is in the past. Next up, make sure to take advantage of the benefits that walk-forward testing offers. Walk-forward testing your algos is a great addition to backtesting. Otherwise, it is also very important to correctly account for trade costs and restrictions besides the obvious trade commissions. Furthermore, make sure not to go too big too soon. When you're ready to feed your algorithm real money, make sure to start out small and then slowly scale up if everything works fine. If your algorithm has proven itself over and over again, you should trust it. This means that you shouldn't interfere with it on every second trade. Otherwise, you'll never know what your algorithm actually is capable of. When developing your own trading algorithm, make sure to fully understand and think about every aspect of it. This means that you shouldn't just copy someone else's code and hope for the best. In addition to that, it's important to thoroughly comment out your code so that you can always come back later and still understand what's going on. The ninth algorithmic trading mistake is not accounting for risk when evaluating your algorithm's performance. Obviously, the total return of your algorithm is important, but it is just as important to understand how your algo achieved this return. Last but not least, make sure to develop a trading strategy before you try to create a trading algorithm. A trading algorithm simply is one concrete way of implementing your trading strategy. I highly recommend checking out my video on algorithmic trading strategies to get some inspiration. With that being said, I truly hope you enjoyed this video and learned something new. If you have any suggestions for future videos, definitely make sure to let me know in the comment section below. Otherwise, make sure to smash the like button, subscribe, and turn on the notification bell for more content like this. Thanks for watching.